gold is moving toward $5,000 an ounce. At the same time, several major banks are quietly leaning on emergency liquidity facilities. On the surface, those two facts should not exist together. High interest rates are supposed to pressure gold. Stable banks are supposed to reduce demand for safe assets. And yet, here we are. Imagine a regional bank facing sudden deposit outflows. Nothing dramatic, no long lines outside branches. Just large, quiet transfers moving to money market funds and larger institutions. In response, that bank taps a central bank liquidity window designed for temporary stress. Officials describe the system as resilient. Analysts call it contained. Markets, however, begin to behave differently. Gold does not spike in panic. It climbs steadily, methodically, almost patiently. This is the contradiction. If the financial system is stable, gold should not be breaking historic levels. If banks are well capitalized, depositors should not be reallocating at scale. When both events happen at the same time, it suggests something deeper than a news cycle. Gold is not a growth asset. It does not produce cash flow. It does not innovate. When gold rises sharply, it usually reflects distrust in something else. Currencies, banks, or sovereign balance sheets. A move toward $5,000 is not about excitement. It is about protection. Meanwhile, central banks expand lending facilities. Balance sheets quietly adjust. Emergency tools, once described as temporary, become normalized. The language remains calm. The actions suggest caution. This is not a collapse story. It is a pressure story. Rising gold and banking strain are not random events. They are signals. Signals that the system may be carrying more duration risk, more leverage, and more hidden fragility than headlines admit. The key question is not whether gold can reach $5,000. The real question is why it would need to. And to answer that, we have to examine what rules of the financial system may already be breaking. To understand why gold would even approach $5,000, we need to revisit the old rulebook. Traditionally, gold struggles when interest rates are high. Higher rates mean bonds offer better returns. Cash earns yield. The opportunity cost of holding gold rises. In that environment, gold usually weakens. Strong banks and stable currencies reinforce that pressure. When confidence is high, insurance is less necessary. But this time, gold is rising while rates remain elevated. That breaks the pattern. At the same time, central banks around the world are increasing their gold reserves at a pace not seen in decades. They are not traders chasing momentum. They are long-term allocators adjusting strategic reserves. That is signal number one. Signal number two comes from the bond market. Yield curves invert. Liquidity thins in key segments of sovereign debt markets. Volatility spikes in instruments that are normally calm. The bond market, often described as the system's stress monitor, is flashing caution, even when equity markets appear stable. Signal number three is more subtle, but equally important. Repeated emergency measures to stabilize banks, special lending programs, expanded collateral rules, quiet guarantees. Each intervention is framed as temporary, yet the frequency of intervention increases. To make sense of this, we need simple mental models. Gold functions as trust insurance. It tends to rise when confidence in financial intermediaries weakens. Banks operate as duration risk machines. They borrow short-term and lend long-term, making them sensitive to rapid rate changes. The bond market acts as an early warning system, pricing in stress before it becomes visible. If gold is rising despite high rates, it suggests the issue is not inflation alone. It may be about confidence in the system's plumbing. And when confidence shifts at the sovereign level, the story expands beyond banks and bonds into global power. When confidence begins to shift at the sovereign level, the lens must widen. This is no longer just about banks managing duration risk or bond markets flashing stress. It is about global power realignment. Gold is not merely a commodity. It is a geopolitical asset. Over the past decade, countries such as China and Russia have steadily increased their gold reserves while reducing exposure to the US dollar system. This is not symbolic. It reflects strategic reserve diversification in response to rising geopolitical friction. At the same time, supply chains are being reorganized along political lines. Energy flows are shifting. Critical metals are being secured through bilateral agreements. Semiconductor production is being reshored or redirected toward allied nations. Trade networks that once prioritized efficiency are now prioritizing security and alignment. As trust between blocs declines, payment systems diversify. Cross-border settlement mechanisms outside traditional dollar channels gain attention. In that environment, gold functions as neutral collateral. It carries no counterparty risk and no political alignment. It can settle balances between nations that may not trust each other's financial infrastructure. The concept of financial weaponization has also changed behavior. Sanctions, reserve freezes, and exclusions from global payment systems have demonstrated that access to dollar liquidity is not purely economic. It can be strategic. When sovereign reserves can be restricted, central banks reassess how they store national wealth. This battle is not about retail investors buying coins. It is about sovereign leverage and monetary independence. If gold approaches $5,000 in this context, it may signal a slow transition toward a more multipolar financial order. And that transition carries consequences for currencies themselves. And when the financial order begins to fragment, the pressure does not stay in geopolitics. It flows directly into money itself. Banking stress and gold prices ultimately connect through currency dynamics. When banks face liquidity shortages or solvency concerns, central banks step in. They expand lending facilities, widen collateral rules, or increase balance sheets. These actions stabilize institutions in the short term, but they also increase the supply of money in the system. Now add another layer: sovereign debt. Most advanced economies are carrying historically high debt loads. Governments rely on manageable interest costs to sustain that debt. If rates remain high for too long, refinancing becomes expensive. Fiscal strain grows. Banks, already sensitive to rate volatility, absorb losses on long-duration assets. Central banks are then trapped between difficult choices. If they keep rates elevated to defend the currency, weaker banks may fracture. If they reduce rates to relieve banks and governments, currency pressure builds. In both scenarios, gold can rise. In one case, it reflects financial instability. In the other, it reflects currency dilution. This is where the idea of silent devaluation matters. Savings rarely vanish overnight. Instead, purchasing power erodes gradually. Inflation chips away. Currency depreciation reduces global buying power. Financial repression, through low real yields, transfers value quietly from savers to debtors. The chain is not dramatic, but it is logical. Debt leads to rate pressure. Rate pressure exposes bank fragility. Fragility triggers liquidity support. Liquidity support stresses currency credibility. Currency stress drives asset repricing. Gold, near $5,000, would not be a lottery ticket story. It would be a signal that purchasing power is being recalibrated across the system. And that recalibration eventually reaches households, businesses, and individual balance sheets. And once purchasing power begins to recalibrate at the system level, the effects do not remain abstract. They move into everyday financial life. For households, the first question is simple: where's your money actually held? A savings account is not cash in a vault with your name on it. It is a liability of a bank. That introduces counterparty risk. If the institution faces stress, access to funds can become uncertain, even if deposits are eventually protected. The second mental model is liquidity versus solvency. Liquidity means an institution can meet short-term withdrawals. Solvency means its assets exceed its liabilities over time. A bank can appear healthy on paper, yet struggle if too many depositors demand funds at once. Rapid rate changes expose that weakness because long-term assets lose value while short-term funding costs rise. The third model is asset money versus liability money. Bank deposits are liabilities of financial institutions. Physical assets, such as gold, are not someone else's promise to pay. That distinction matters when confidence declines, even slightly. The fourth model is systemic versus isolated failure. Not every bank problem becomes a crisis, but contagion spreads through perception. If depositors believe others may move funds, they act preemptively. Institutions hedge quietly. Liquidity is repositioned without headlines. Gold often reflects that quiet repositioning. It does not require panic. It responds to gradual shifts in trust. None of this implies imminent collapse. The goal is literacy, not alarm. When viewers understand these frameworks, they can interpret signals calmly instead of reacting emotionally. And with that foundation, we can now consider what paths the system might take next. With these mental models in place, we can outline 3 plausible paths forward. None are predictions. They are structured scenarios built from the pressures we have already discussed. The first is a stabilization scenario. Banks recapitalize. Unrealized losses are absorbed over time. Interest rates gradually normalize as inflation cools. Liquidity facilities shrink quietly. In this environment, gold may cool from extreme levels because trust slowly rebuilds. The system bends but does not break. Confidence returns in stages. The second path is a currency drift scenario. Banks survive, but debt burdens remain high. Central banks keep rates below inflation to ease government financing costs. Real yields stay compressed. Purchasing power erodes slowly, almost invisibly. There is no dramatic crisis, only gradual financial repression. In this world, gold remains structurally elevated, not because of panic, but because of persistent dilution pressure. The third path is a system reset scenario. Geopolitical fragmentation accelerates. Reserve diversification intensifies. Alternative settlement systems expand. Discussions around gold's role in international collateral frameworks become more explicit. This would not mean a return to a classical gold standard, but it could signal partial remonetization in cross-border trade. In that case, a $5,000 gold price would reflect structural redesign, not temporary stress. We must emphasize uncertainty. Complex systems rarely follow clean narratives. Outcomes overlap, timelines stretch. But one point is clear. Gold at $5,000 would not be random. It would represent cumulative pressure across debt, banking stability, and geopolitical alignment. And that leads to the next question. If gold is signaling structural change, what happens if the bond market confirms it next?